You have equity in your home, but you also need cash. Maybe credit card balances are growing. Maybe your home needs repair. Maybe you want major improvements, but your current rate may be too valuable to replace. So, which option makes sense? A home equity loan, HELOAN, a HELOC, which is a home equity line of credit, or a cash out refinance. Before choosing, consider three important things. Number one, how much cash do you need? Number two, do you need everything now? Or will expenses happen gradually? Number three, is replacing your current mortgage worth the long term cost? I'm Cathy Sabater. I'm a mortgage strategist. Let's compare all three options. First is a home equity loan. It is sometimes called a HELOAN. You receive one lump sum. The rate is usually fixed. The payment is usually predictable. Your existing first mortgage stays. You now have two payments. This may fit some homeowners who know exactly the amount needed. Maybe 40,000 for repairs or one specific debt payoff. You receive everything at closing and interest begins on that balance. Now, consider a HELOC, home equity line of credit. It works more like a revolving credit card. You borrow only what you need and you can repay it and reuse it. Your first mortgage also stays, but HELOC rates are variable. That means payments can change. Many HELOCs have an initial draw period. During that draw period, payments may be interest only, but later the repayment begins. Your required payment may increase. A HELOC may work better when expenses happen in stages. Maybe you're just remodeling and you're only remodeling one room at a time. You avoid borrowing everything immediately, but flexibility requires discipline. Available credit is not free money. Your third option is a cash out refinance. This replaces your current mortgage with one larger first mortgage. You receive the remaining cash after costs and required payoffs, and you usually will only have one mortgage payment. But here is the issue. The new interest rate applies to your entire mortgage balance, not only the cash received. Replacing a very low rate can create an expensive trade-off, especially for smaller cash needs. Cash out refis may work when your current rate is higher or you need substantial cash. One fixed mortgage payment may also fit better. Now, let's return to the three important questions. First, how much cash is needed? A known lump sum may favor a HELOC. Second, when do I need it? If you're having expenses occurring in stages, then that may favor a HELOC. Third, should you replace your current mortgage? A cash out refi changes your entire first mortgage. Paying off credit cards can also improve cash flow, but it does not erase the debt you owe. It moves unsecured debt onto your home as collateral. So without changing spending habits, those balances can return. Then you're going to have both debts again. But let's compare the interest rates, the closing costs, the monthly payments, and the repayment terms and the total interest paid. Use the first link below to get my free home equity options guide. Then comment equity below. Tell me which option that you're considering, and we can make sure that before you change your current mortgage, we schedule a personal strategy review. This is data, not hype.